Something is happening in the silver market right now that almost nobody is reporting. Millions of ounces are quietly disappearing from registered vaults, not in a slow trickle, but in waves large enough to make veteran traders stop and take notice. And the people moving this silver are not retail investors buying coins from their local dealer. These are institutions, refiners, and entities with access to information most of us will never see first. If you have any exposure to silver, or you have been thinking about starting a position, the next few minutes could change how you look at this market completely. Because what is unfolding right now has the fingerprints of something much bigger than a simple price rally. For years, silver has lived in the shadow of gold. Central banks make headlines when they buy gold. Governments brag about gold reserves. But silver has always been the quiet metal, the industrial workhorse that gets ignored until suddenly it isn't. And that is exactly what makes this moment so important. Right now, COMEX warehouse data is showing a pattern that should make every silver holder pay close attention. Physical inventories are tightening even as paper contracts pile up. That divergence between paper promises and physical metal is one of the oldest warning signs in commodity markets. It tells you that more silver is being claimed on paper than can realistically be delivered if everyone asked for their metal at once. But here's what almost nobody is talking about. This is not just a COMEX story. It is happening at the London Bullion market too, where leasing rates for silver have spiked in ways rarely seen outside of genuine supply stress. When leasing rates spike like this, it usually means somebody with deep pockets needs physical silver immediately and is willing to pay a premium to get it. That is not how a calm, well-supplied market behaves. So who is actually buying? Industrial demand is part of the story. Solar panel manufacturing alone now consumes a staggering share of annual silver production. And that demand is only growing as countries chase renewable energy targets. Electric vehicles, 5G infrastructure, and military electronics all require silver in ways that simply did not exist a generation ago. But industrial demand alone does not explain leasing rate spikes and vault drawdowns of this size. This is exactly why smart money is moving early. Hedge funds and institutional desks appear to be quietly building positions, not through flashy public announcements, but through steady accumulation that barely moves the price until it eventually has to. Now pay close attention because this is where the story gets serious. While silver investors have been distracted by short-term price swings, central banks have been rewriting the rules of the entire monetary system. The Federal Reserve continues to wrestle with a debt load that grows heavier every single quarter, while insisting that inflation is under control. Meanwhile, the European Central Bank is fighting its own battle, trying to support a fragile currency union, while member states carry wildly different levels of debt and economic strength. This is the backdrop that matters. When confidence in fiat currencies weakens, history shows that capital eventually searches for something it cannot print out of thin air. Gold has always been the first stop on that journey. But silver, because of its lower price point and dual role as both a monetary and industrial metal, often becomes the explosive second stage of that move. Look at what happened in the 1970s. As inflation spiraled and confidence in the dollar collapsed, silver did not just rise alongside gold, it outran it, multiplying many times over in a relatively short window. That is the historical pattern that long-term holders are watching for right now. Not a slow grind, but a sudden acceleration once the broader public realizes what is happening. Inflation data across Europe and the United States continues to show that price pressures are far from fully tamed. Energy costs, housing, and food prices remain elevated compared to pre-pandemic levels, even as headline inflation numbers get massaged to look more comfortable than they feel in everyday life. Citizens across the Eurozone, from Germany to Italy to Spain, are feeling their purchasing power erode in ways that official statistics struggle to fully capture. This changes everything for silver investors, because silver is not just a speculative trade, it is a form of insurance against exactly this kind of slow currency erosion. When people lose faith in the long-term value of euros or dollars sitting in a savings account, physical metals become one of the few assets that cannot be devalued by a policy decision made in a boardroom thousands of kilometers away. Now let's talk about the supply side, because this is where the story becomes even more compelling. Unlike gold, which is primarily mined for investment and jewelry, the majority of silver mined each year is consumed by industry and never returns to the market. That means the available above-ground supply for investment purposes is shrinking relative to demand year after year. Mining companies have struggled to bring new large-scale silver projects online quickly enough to offset this consumption. Permitting delays, rising energy costs, and geopolitical instability in key mining regions all add friction to new supply reaching the market. When you combine shrinking available supply with rising industrial and investment demand, you get the classic ingredients for a supply-demand imbalance that can persist for years. So what happens next? Let's walk through the realistic scenarios, because no serious analysis ignores risk in either direction. In the bullish scenario, continued vault withdrawals, combined with persistent inflation and a weakening currency, environment trigger a broader wave of investor interest in silver, As more capital enters the market chasing limited physical supply, prices could see a sharp acceleration similar to previous historic silver rallies. Institutional buyers who got in early would see substantial gains, while latecomers would be forced to chase an increasingly expensive market. In a more measured bullish scenario, silver continues a slower, grinding rise as industrial demand steadily absorbs available supply, rewarding patient long-term holders rather than producing a dramatic spike. This scenario favors investors who treat silver as a multi-year wealth preservation strategy rather than a quick trade. Now for the bearish risks, because ignoring these would be irresponsible. If central banks manage to convincingly tame inflation while maintaining economic growth, some of the urgency driving precious metals demand could fade. A sudden global economic slowdown could also temporarily reduce industrial demand for silver, even if monetary demand remains strong. Short-term price corrections are always possible, even within a longer-term bullish structure, and investors who cannot stomach volatility may panic sell at exactly the wrong moment. There's also the risk of aggressive market intervention. Regulators could increase margin requirements or adjust market rules in ways designed to cool down rapid price movements, creating short-term volatility that shakes out less experienced traders. What happens next could shock most investors, simply because most people are not positioned for any of these scenarios. Many retail investors remain completely unaware of the vault withdrawals, the leasing rate spikes, or the structural supply deficit building beneath the surface of this market. By the time mainstream financial media begins covering this story in depth, much of the early opportunity may have already passed. This is the uncomfortable truth about every major market shift throughout history. The earliest and most asymmetric gains almost always go to those who pay attention before the crowd arrives. Once a trend becomes obvious to everyone, the easiest profits have usually already been made by those who positioned early. So where does this leave you? If you already hold physical silver, this is a moment to understand the deeper structural forces supporting your position, rather than reacting emotionally to daily price swings. If you have been sitting on the sidelines, this is the kind of environment that historically rewards those who begin building a position methodically, rather than waiting for a headline to confirm what the data is already showing. Wealth preservation is not about predicting the exact day prices move. It is about positioning yourself ahead of structural shifts in the monetary system, currency stability, and global supply chains, so that when the broader public finally notices, you are not the one scrambling to catch up. The signals are already here. Tightening vaults, spiking leasing rates, persistent inflation, and a supply deficit that shows no sign of reversing anytime soon. History does not repeat perfectly, but it rhymes often enough to respect the pattern forming right now. If this breakdown opened your eyes to what is really happening beneath the surface of the silver market, make sure you subscribe and turn on notifications so you do not miss the next critical update. Drop a comment with the word silver if you believe this metal is about to make its move, or gold if you think the bigger story still belongs to the original safe haven asset. Either way, the time to understand what is coming is now, before the rest of the world catches on.